Well, greetings, everybody. Welcome on this summer Tuesday afternoon to both sessions with Mark Robertson and Ken Kavula. I'm Mark. Ken is also here joining us. Say hello, Ken.
Hi, everybody.
And that, believe it or not, is our agenda, Mad Men, that tantalizing bull with the apple, which just continues to get more gruesome every day, Ken. Our seller's remorse is really getting quite chronic. You know, it's pretty tough. And then, of course, the red rabbit, which many of you know is one of our symbols of better or best small companies. So let's go ahead and get underway. You guys all know the drill. No investment recommendation is intended. This is all about demonstration and illustration of the techniques and the methods and the philosophy of the modern investment club movement. Please do your own homework. We may own companies that we talk about. We may talk about companies we have recently sold and wish we hadn't. So keep that in mind. If you would like a reminder for our roundtable webcasts, which now have 10 years in the can, and we're starting a new decade here in 3 weeks, please send a request for an email reminder to nkavula1@comcast.net. If you would like copies of these slides, or if you have follow-up questions, or even more importantly for this session, if you have requests or questions for future topics, please let me know. We'll show you where we're filing those and how we intend to follow up on those. And that is my email address, markr@manifestinvesting.com. Thank you. All right. Well, first, a provocative quote to start the day, just as a reminder of things can happen. I didn't remember this, but Commodore had a 34% market share in 1985. To me, that's kind of stunning.
First computer that I ever owned, first computer that I did serious work on was a Commodore, Mark.
Absolutely. And
we had Commodores at school. We thought that was the end-all, be-all, and that was going to be the dominant company in the market.
And it was a pretty slick machine, but oh my, compared to what we deal with these days, pretty good.
Well, as far as education was concerned, the only serious competitor, and this is pre-PC, the only serious competitor were Apples at that point. So.
Yeah, and I can remember my first Apple II Plus, and that's a story for another day because we're going to talk about other stuff Apple. But what you see here is the queue or the bullpen. And this will serve as kind of a standing, living potential agenda. And you can see I've highlighted the 3 sessions that we're going to be talking about here today. In the case of Apple, this notion of recency bias, because there's an awful lot of optimism and momentum, which I would put into the recency bias category, versus seller's remorse. And we certainly have that after selling the stake in Apple from the roundtable portfolio back in May. And then we will talk a little bit about Don Draper and fixing WPP. Ken said he had a couple questions on that, and we'll dig into that. And then a quick look at our best small companies for this year. The clock runs out come Halloween. So we've got 3 months left on the clock, so we don't want to spend too much time talking about it. And Ken, did you want to talk about how we've decided to basically dedicate the last Tuesday of the month?
Well, yeah, we thought that since we run a roundtable on the last Tuesday of the month, that we'd like to keep the bull session really focused. So we're going to call it the mailbag session, last Tuesday of the month, and we're going to deal with questions from our audience. So if you have something that's been pressing, something you'd like to discuss or have us discuss, send us a line, drop us a line. You have Mark's email address. Drop us a line, and then we'll devote, we hope not more than 30-35 minutes on that session to Q&A. And it'll be a shortened session because we do come back for the roundtable that evening at 8:30 p.m. Eastern time. So we're going to try that for a couple months and see if we can keep it to 30, 35 minutes. We tried last Tuesday. That was just a week ago. We tried to run a shortened version there and ended up going for more than an hour. So we're not real disciplined when it comes to time right yet, but we're going to try to get there.
Hey, we never said we were disciplined, so we're learning. We're learning with all the rest of you. The discipline matters. All right, just a quick look at one of the graphics that we like to put up in the long-term chart. The reason I put it up is the stock price is in the general stock market. The stock price index, as shown here by the value line arithmetic average, continues to go up. It's not at its all-time high yet, like some of the other parts of the stock market, but it has peaked back up above 6,000 for this particular average. Again, that's the average of all the companies in the value line standard edition. The other thing that I'd like to point out is the return forecast, as known by the value line median appreciation projection, has again dropped down into fairly fair valued range for most companies, and the overall index is now back in that 10%, 11% range. And so the fervor and frenzy of March, first quarter of this year, has kind of cooled off, and we're kind of back in the normal zone. So we'll just leave that go for now. Just wanted to show that things are returning to normal. All right, here's our 20 selections for this year, a work in progress, and I am absolutely thrilled to be able to report this. I will knock on wood, because I jinxed this a year ago. We don't want to put too much emphasis into this, but I am happy that our 20 selections are beating the market by over 10 points at this point in the process. I will confess to you that I was very concerned about the presence of Wingstop and Shake Shack in the same portfolio, and fortunately Wingstop has kindly bailed us out. Notice that the gains in Etsy, I mean, I don't own any Etsy. Ken, do you own any Etsy?
No, I've looked at it before, and it's the kind of company that I need as a non-core, and I just frankly had enough non-core, so I didn't buy any of it.
I don't even know what they do. They got to do something with retail, right?
Yeah, yeah. That's a good one-word definition for what they do.
But I mean,
I
go ahead.
I sit in an investment club where one of our members is a high flyer. He loves to take stabs at various things, and he announced 4 months ago that he had bought Wingstop on the strength of our recommendation on the small companies list. I pointed out that these were not recommendations. He said, well, it was at the top of the list. I said, that was past performance. You need to kind of watch where it's going to make a determination. I thought he was a little bit off on his timing, but the last 4 months for Wingstop certainly have been real dynamic. What draws my attention on the list right now, Mark, is that this list is not usually split 50-50 like it is right now between ups and downs. It's usually closer to 60-65% up.
Yes.
So we do have more downs, but we have enough up to balance that out and give us a nice relative return. I don't know what that says about the market, but I think it points out that you have to be extremely careful right now when you're looking at these small stocks, that a lot of them, that especially with no earnings, a lot of them are showing us dramatically great sales growth, but they haven't begun to earn anything yet. That might be a good thing, but it might also indicate that we've jumped on their bandwagon just a little bit too quickly. I'm not sure yet. I want to watch them carefully.
Mm-hmm.
I do own some on this list. You probably own some too, don't you, Mark?
I own a couple of them. I mean, Universal Display is one that came through the roundtable years ago. I do not own any DMC, but I've looked at it a number of times. That's also a roundtable stock. But the one that I have owned, and you can probably guess which one of the 20 that I currently own, is that one at the bottom. And in fact, Canada Goose has gone through a number of things. I mean, retail in general has been rocked, and they have some some, I'll just call them issues, and we'll just leave it at that. Perception issues, and well, I shouldn't even call them perceptions. Let's just call them issues. I will add that Canada Goose was just added to the Tin Cup portfolio because a lot of times it makes sense to look more closely at the stocks at the bottom of a list like this. Again, this is a work in progress. Companies that have been kind of laggards, I would point everybody to NV5 and Willdan as companies that might prosper from any uptick in infrastructure spending. Planet Fitness, if we ever get out of the situation we're in where no more than 6 or 10 people can be in a gymnasium, Planet Fitness has had a pretty good run going and is persisting fairly well, but obviously they're a bit handcuffed. If those handcuffs ever come off, that could be an interesting thing to study. And again, biotelemetry, we've talked about extensively, ticker symbol BEAT. I think that's just a good long-term, what do we call them, Ken? An investing theme, biotelemetry.
Yeah, I think that Paysign is another very interesting company with a great story behind it and a pretty nice visual analysis. I think that Paysign deserves a second, maybe even a third look. And I'm also going to say something about Canadian Goose. In my one investment club, we try to distill lists of good stocks and bring them down to a place where we can put them on a very short list for purchase. And we're taking a look at Canada Goose again at our next meeting as an example of PEs. We kind of believe in PEs, and I know that you have some problem with PEs sometimes, but we're looking at Canada Goose as a company that's maybe growing into its PE, and it's growing into a more reasonable PE, and it's doing it pretty quickly. And we kind of like that idea. We would hope that the growth continues and the earnings continue, but there's been a lot of PE contraction in that company right now. And maybe it's a much more opportune time for us to take a look at it. We looked at it about 1.5 years, 2 years ago and rejected it completely. One, because it didn't have very much history attached to it, but secondly, because it was just in the realms of beginning public trading and was doing all kinds of wild things. But coming back to it right now, we like it much more than we did 2 years ago, and we're going to take a serious look at it. I mean, people need coats. Maybe even expensive people need really expensive coats, you know.
Absolutely, yeah. It's been beaten down enough that it's probably into that range, hence the position on Tin Cup. All right, let's go ahead. We'll come back and take a look at that one more time to try to jinx it. What I thought we would do is spend just a moment reinforcing that topic we've been kicking around, this projected return on value, PROV with a little e, PROV. It literally is taking I believe it takes the methodology of the stock selection guide and deploys it in a slightly different manner, one that perhaps offers, call it a balance or a checkpoint or an auditing mechanism. That's what we're going to look at here in a minute. But again, I would encourage everybody in the audience to just kind of scroll through those talking points that we have talked about in the past. We're not going to stop talking about them. We continue to search for ways to help get our arms around this as a potential weapon in our arsenal. So just keep that in mind. A number of you had commented to me, even though this is a little bit hazy, you wanted to see a little bit closer look at what was on that. This was actually in the 5th Better Investing issue ever published, and it's just a visualization of the fact that the visual analysis only had sales and pre-tax earnings graphed on it back in the early days of the stock selection guide. You can see the caption up there in the middle of the page. If you want more on that subject, you can either go to that Manifest Investing article, or you can just Google Manifest Investing and the word muskrat, and you'll be taken to that as a subject. And
Mark, if you stay on that slide, I'm going to give people a presentation trick that I've been using quite a bit as I prepare presentations. Mark has a fuzzy right here because it comes from the fact that he did a screen capture on a relatively small part of the screen and then expanded it. I find that if you expand your screen first with your mouse wheel or your buttons, whatever you need to do to expand the screen, and then do your capture, you can a lot of times avoid all this fuzziness that's going on the capture right now.
I'll give that a try because, I mean, obviously we're starting with a small image.
Right.
It was
And I found that if I expand it on the screen first of all, and then copy it and capture it, it seems to give me a much better capture.
I'll give that a go. Thank you.
Yeah.
All right, so the company I wanted to kick around in true Don Draper fashion and illustrate kind of how we've talked about this a little bit. And again, forgive us, folks, this is a work in progress. So you'll hear Ken and I just kind of working through this and thinking through this. I know he's got some questions, but what I've tried to stack up for you is the value line that would have been out on WPP, which is one of the leading advertising agencies, actually an agency of agencies in the world when it comes to advertising. So this is just literally a week old. And the thing I want to draw everybody's attention to is, again, with the numbers that you see here from the analysis from Value Line, you end up with a projected annual return of about 30%, 29.7%. What I want to draw the contrast to is the two red circles and the fact that those two numbers are dramatically different. And to me, that's a sign that potentially there's more homework that could be done with a company like WPP. Nick Strategos and I talked about this back around Christmas time, where anytime you see a dramatic mismatch that large in those two numbers, maybe you go back and you scratch your head over the things which would influence that. And again, going back to this slide, what would make that projected return on value, high or low in a situation? What would you audit? Well, you would audit the sales growth and the sales situation, sales characteristics, along with everything that basically leads up to a projected pre-tax income. In addition to any of that stuff on the bottom, but you can see basically those two are quite a mismatch. Now, the one number that is really different between the two, because it's in the number up at the top, the PE actually has influence on this top number, 29.7. There's no PE in this number. So again, the first number that is flagged for me when I see this condition or this situation is I ask myself questions about this number and just wonder, could it be too high? We look down here and we see the PE ratio over time. Do I believe that 16 is an appropriate number? Or if I'm actually in my investment club, or if I'm scratching my head over an investment of family money, and do my eyes get drawn to this? And do I begin to at least lobby in my own head? Sometimes I have wonderful debates talking to myself. Ken has witnessed some of those. Would I be more likely to come in with a number like 10? With a number like 10 for future PE, notice that the projected annual return drops down into that 11 to 12% range. I'm actually starting to get a much better feel for this. Now, one of the other things that comes to play in this company that I want to point out is this dynamic right here. This company is in the middle of divesting parts of their business. That's what accounts for some of this drop-off that's here in 2020. So you have to account for the change in the structure of the company. And in fact, the really big giveaway on this is when the next report comes out and any of this stuff closes and they've actually complete some of these divestitures, that number there on the far right is the Value Line 3 to 5 year forecast, which basically ignores any M&A or divestiture activity. So you will begin to see adjustments. By the way, these three numbers here are analyst consensus numbers, and they are already factoring in call it portfolio management, corporate portfolio management, divestitures that are going on at this company. So again, we're looking at a different company growing at a 2 to 4% growth rate, and that's basically what comes into play. This number becomes a little bit lower. This number could be anywhere in that 2 to 4% range. Hopefully they will come up with a series of decisions which improves that number. But overall, this is beginning to paint me a little bit more credible picture. Now, I know there's a lot of lines on there. Ken, what are your thoughts?
Well, my first question, Mark, is if current sales, the first bold line there, if current sales is trailing 12 months, how are they different at the same date? I know the one comes from value line. Where's the 140 or the 14? I don't know whether that's million or billion, but where's that 14 number come from then?
That's a number that I've completely made up to reflect what the analysts are seeing, because right now there's no number that can really be relied on, especially at value line for year end 2020.
So that trailing 12-month number is not based, that 170.30 is not based on anything?
It's based on a blend of analysts, some who are accounting for the divestitures, some who are not.
Wow.
It's a mess. Anytime you get into a company like this, it just is it's a structural mess until it gets sorted out. And again, keep in mind that this is a problem we've always had with value line. I don't know if it's a problem. It's a process, a procedure that they follow, that they will not issue modified or pro forma type stuff, based on the restructuring of any company until it's a absolute done deal. Meanwhile, as is shown,
go on, finish your thought, Mark. No,
these two conditions, the sales that are depicted here and the earnings that are depicted here, are the analyst consensus estimates of the new company. You follow me?
See, well, yeah, but my thought always was, when I was looking at trailing 12-month sales on a value line sheet, I thought that I was looking at things that had already occurred, that were booked, that had been sold.
True, but
I didn't.
Go ahead.
Well, I didn't realize that the company could go back and change those booked numbers to some other numbers by divestiture.
Well, they sell off. Let's say they sold half the business. It goes from 17 billion down to 8. They don't go back and restate that 17. I mean, there's no restatement.
I understand all that. So going forward, I understand that the number is radically different. But on the same date, I would think that trailing 12-month sales should be identical in both studies.
Well, again, one includes operations which are.
Yeah, I hear you. I'm gonna have to really think this whole thing through then, because if that date at the top of the second column were 3 months later or 6 months later, I would understand the number going down,
Mm-hmm.
But when that date is the same, I don't understand how that number can change. I'll have to think that through. Yeah.
Again, it's a personal attempt on my part to try to account for the change in the business, the restructuring that's going on. Because keep in mind, in the data array by value line, they did not go back and restate the discontinued operations. Okay? And that's what really messes up the annual rates box for a number of companies too.
Well, I guess that I understand what the attempt is. I'd be more comfortable, however, if that were a 1024 date on top with an adjusted price, a new price, and a new sales number. Then we can compare one quarter to the quarter when it was before the the disruption started to happen. Has the disruption actually occurred on 7/24, or is it coming?
Yes, some of the operations have been discontinued already.
Okay.
And it's not reflected in value lines. So anyhow, the big moral of the story here, I understand how jumbled it is. It's the type of thing we run into any company that is reconfiguring. You have to really decide, what's relevant about the graph. And in this case, the only thing that's relevant is 2020 and beyond for forming the numbers that we're trying to form on the left. Now, what is also...
Mark, we have Ann Manning's hand that's been in the air for a reasonable amount of time. So I'm going to unmute Ann and let her ask her question, okay?
Excellent. Thank you.
Ann, go ahead.
Can you hear me?
We can hear you. Go on.
Hello?
Greetings.
Yeah, we can hear you.
The question I have is, and I've had this for a while, listening to the deal about the PROV. When you look at this WPP and you look at the par is 11.6, I think, and then you go down to the PROV deal and it's 4.2. So I don't understand. From what I've seen, all the examples y'all have done, it's always, the PROV is always lower than the par. So what is that telling me?
Okay, that's a great segue question.
Is it telling me anything?
That's what we're going to talk about next. The relative level of the PROV numbers is slightly less than the pars, and I guess on a relative basis, you just let's say that the average projected return on value right now is, well, we're going to see it. It's right around 6 or 7%, and the average par runs closer to 9. So there seems to be that amount of difference for the average company. So the par is gonna run slightly higher. I think much of the time it's running a little bit higher now. So what it really comes down to is, as we spend more time with these numbers, we're gonna see them. I think we're gonna see them all kind of come together, and that's what we're going to talk about next. But right now, the projected annual returns, in my opinion, are going to be running a little bit higher than the PROVs. Okay? It'll take some time just getting used to the numbers, just like the type of familiarity we have with general PE levels, all that kind of stuff, growth rates. But I think over time, these numbers are going to resemble each other a little more closely, and that's what we are going to talk about. Okay? Anything else, Ken?
Not at the moment, Mark.
Okay, so we'll come back and we'll do other demonstrations, perhaps that are a little bit less disrupted, where you can see that can serve as an audit, which would be less, it would be not confused by the fact that this company is trying to reinvent itself. So let's talk about what all of us want to talk about here today. Apple. And you know how usually I put big arrows on charts? Can you find the place where we sold Apple? That arrow's a little bit smaller than most, right? Yeah, here's where the round table actually exited the Apple position. And in a nutshell, we've come to the conclusion that we probably should have put in a 10% or a $20 or pick a condition trailing stop to follow this baby up. I don't know whether we would have sold it a month ago, but we should have used a trailing stop limit order. That was in our arsenal. For a company like this, it makes a lot of sense. And with 2020 hindsight, we can look back and say that volume has returned to Apple. It's going through a lot of stuff, but it's quite a ride. All right.
I'm going to make the same case, Mark, that I've made to you privately, that in dynamic portfolio management, you seem to have two things that are always fighting with each other. One of them advises us to hold our core holdings until they fall below money market rates. And the other says, try to keep your par, 4, 5, 6, 7% above my par. And to do that, you have to move stocks that aren't performing at average or better. You have to move them out of the portfolio. So you have that tug, that back and forth between those two issues. I'm wondering if when we have a stock that we can point to, that anybody can point to and say core, I'm wondering if that shouldn't be something that causes us to pause before we pull the trigger and sell for valuation purposes. I mean, some of the stocks that we've called core are really kind of a toss-up as to whether you'd say that's a core stock or not. But you have this group of high-performing growth companies that I think almost anybody can point to and say for the last, X years, this has been a central position in my portfolio. I think that maybe that gives it an extra bit of credibility and an extra reason to keep it in the portfolio rather than just let it disappear because it's at the bottom of the list along with 4 or 5 other companies. We're not having this discussion, this regret on some of the other companies we sold, and rightfully so. Mm-hmm. But we are having this regret on this high momentum, widely held stock, and I think it means that we have to constantly be thinking about these 2 rules that we've put there for our portfolio that a lot of times are in direct conflict with each other, and we haven't given them any priority as to which is more important. Although at that meeting, we decided bringing the portfolio's par up was more important than keeping our hands on the Apple stock until it moved down below money market rates. So I don't know if I have an answer for what I'm saying, but I'm pointing out that probably when it's all said and done, part of our conclusion is going to have to be that there are a select number of stocks in our portfolio that deserve extra consideration when they fall under my par, but they're still well above money market rates.
Right, and this one was actually just slightly above money market rates at the time we made the decision. By the way, just in the last 3 days, this red bar would be here now. The red forecast projected annual return line would be down here because the stock price is now up here. So we actually would be in a situation that would have probably triggered a sale anyhow. We're just talking about it probably being early. I actually turned to page 82 of the Investor's Manual, where Nicholson basically wrote, danger in selling growth stocks. It is well to avoid selling a security where sales and earnings per share are enjoying a steady uptrend of more than 10% compounded annually. So I think with, just reinforcing what you just said, Ken, if we're dealing with something that's a slam dunk core holding with a growth rate more than 10%, you want to give it the full leash, is the way I read that. Owning such securities over a long period of time is likely to produce better results than attempting to switch in and out of the security. And I think that's what you're getting at.
I think.
They got to be given room to run. That 10% is obviously a plus or minus number, but it is a situation. This one has dipped down into negative territory when it comes to the projected return. Now that can only change with fundamentals. We'll see how that goes.
I'll tell you, Mark, right now I'm really torn with my own portfolios. I have 2 stocks. In one of them is Apple in my wife's retirement portfolio that's now occupying more than a quarter of her portfolio. And she's really nervous about it. And I've kind of resisted doing anything about it, but I really do think something has to be done. I don't want the whole portfolio to be captive to a sudden drop in a single stock. The other stock is in my taxable portfolio, and it's Microsoft of all stocks, and it's occupying about 22% of that portfolio right now. And again, I'm going to have to make some decisions about how much of that stock I really want to allow to stay in the portfolio. And if I do sell some, I'm going to harvest some really hefty capital gains. Maybe I won't take my distribution this year, my required minimum distribution, and use the taxes I would have paid there to pay for the capital gains instead. We'll have to see.
Yeah, you're probably, well, you don't have to take an RMD for this year and possibly not next year.
Right.
We're deciding that. So yeah,
Right.
Unfortunately, I already took the estate one. You know, the one thing I would say, Ken, I would just say, just looking at it is I have the same situation. Microsoft is the largest holding in Tin Cup. It's also the largest holding in my cash portfolio and retirement portfolios. And what I have done is basically done the same thing we did with Facebook 3 weeks ago, is I took 50% of the position and put it subject to a trailing stop limit order. So, I mean, I'm using that as a means of rationalizing some protection. As Len Douglas said, think of it as an insurance policy. Because I do want to take this to the next level. Because here is Apple, and this, you're going to be more comfortable with this one, Ken, because the two columns are different dates with different things happening.
Yeah, now it makes ultimate sense to me. This whole page made a lot of sense to me, whereas the other page didn't make any sense. So
all right.
I'm glad to see the two different dates on top. Yeah.
I'm going to cry myself to sleep tonight, and I'll come back in a better graphic next week. So what has happened, this is actually from March, was the last, well, 2 updates ago. We've got another one coming in about 5 weeks on Apple. Sales have gone up. Trailing 12-month sales have gone up. The growth rate's actually gone up a little bit. The analyst consensus estimates shown by the arrows on the right-hand side here have all kind of ratcheted up. Even though that's all going on and it's actually pretty robust, the stock price is actually outstripping that. And the stock price is actually going nuts. And that's where I think, even if we're talking partial positions, can start to make sense, because this is real. I don't know whether it's right or not, but if we're diligent and disciplined about the way we do this stuff, you're going to have these situations from time to time. The other number that kind of jumps off the page a little bit is the fact that it's had a lot of momentum. More debt, less cash. There's things going on here that we can actually look at side by side, and you notice that the value line forecast has dipped into the negative.
And here's an example for Ann where the PROV numbers are actually larger than the PAR numbers.
Yeah, they're going to be less dynamic. Call that more stable, I guess. And I'll talk a little bit more about that in a minute.
Mark, we have some people that would like to speak, so I'm going to start by unmuting Marty Eckerly. Marty, go ahead. Marty, you'll have to unmute on your side.
Got it. Thank you.
Hey, Marty.
Ken, hi, guys. Would you back up 2 slides, Mark, please?
To that one?
Right there. Yes, that one.
You like the bull, huh?
Yeah. What do you say for the argument about the trailing stop loss orders? When they trigger, they become a market order.
Right.
But there are times when the stock price will drop dramatically, and you don't get the price that you expect to get, like on where the dip is there, where your red line stops. Is it like this? What do you say about that?
Yeah, you can actually jump over your market order and fail to trigger. I guess my way of thinking about that is that, let's say you had a stop, and let's say you had a stop right here, and the next morning the stock opened right here. Is that what you're kind of getting at, Marty?
Yes. So it doesn't happen at all, or it happens way down.
Right, and I guess my preference in that situation would be for it to be literally a timeout, not happen at all, and let me rethink at this point. You know, maybe I wouldn't want to sell it at that point. So I'm comfortable with that happening across a gap. It's never happened to me where my market order actually transacted significantly below where I wanted it to. I've only done maybe 20 of these in a lifetime of investing, so I've not actually encountered that condition. But in answer to your question, if it really jumped over and through where I had wanted to sell, I would be comfortable with it not executing at that point. So then I would literally be flagged and have to make a decision about it.
But could it also, say the stock really plummeted down, and passed through your market order before the market opened, and then when it opened, it sold way down?
Mm-hmm.
Is that a possibility?
That I believe that can happen. That has not happened to me, but perhaps others have had that experience.
Mm-hmm. Okay, well, it's just my thoughts. Thank you.
You bet.
Thanks, Marty. Len Douglas. Len, I'm going to unmute you. And again, Len, you're going to have to unmute yourself. You're self-muted.
And while Len is doing that, he's been actually adding to his compendium.
There you go, Len. Yeah, there you go.
Okay, Mark, would you go back to that slide that Marty referenced? I wanted to make a comment about that too.
Okay.
The example I showed a week ago was based on a 10% trailing stop.
Right.
And I think this is a perfect example that 10% is about the minimum differential you want to set, because ideally you didn't want to get kicked out here. So
and it would have triggered
from
here.
what I've read online, it looks like the range of 10 to 12 is sort of the consensus for the minimum to set.
It looks like market reached a high of 400.
Yep.
And so 10% would have moved that stop up to 360. And it did break 360. So yeah. I think Len's really right that if you're going to set one of these, 12 or 15 or even 18% might be a number that you might want to consider.
Yeah, in the forum, the posting from, was it Gail Goldstein?
Right.
Who was really happy that the subject came up, and she set her insurance policy at 15% and is doing the happy dance.
Right.
Because, well, none of us knew that Apple was going to have blowout numbers and split. But another takeaway I got from this whole exercise is you want to be very cautious as you approach earnings.
Definitely. You're going to see more volatility.
And I'd like to give a thought on Marty's question. I think the movement is more likely to happen with a much lighter traded stock. Looking at the top of the chart here, the volume was 93.6 million.
Yeah, and we talked about that a couple weeks ago too.
Yeah.
Oh, less liquid stock, you need the numbers to be wider. And in fact, when we picked the number for Facebook, we used minus 20% as the range from the high price.
Yeah, well, as I said a week ago, I think you're buying an insurance policy, and all of us hope our insurance policy never comes due, but sometimes it happens.
Well, and I think you have a large number of investors like my wife, and this is in my wife's IRA, so she has a lot to say about what we're going to do with it. But her philosophy is, you know, if I can get 410 or 415 out of this stock, I'm going to take the money and run. I'm not going to play any games with it.
Well,
so You know, especially since it was trading at 310 or 315 less than 3 months ago.
Yeah,
Yep.
and again, I would point out that type of conclusion is going to be very, very personal and situation specific.
Yep.
If again, if I'm talking about and I'll use it as an absurd example, my 5-year-old grandson Lincoln, we aren't even thinking about any of this stuff. I mean, I would never think about program trades on. I said never. I shouldn't say never. I would be highly unlikely to ever consider anything like this for, a very young person.
But Lincoln's not really experienced like a lot of us on the call are. You know, none of us are old, but we all have a lot of experience. So.
Yeah, but man, can he talk fishing? All right.
Okay.
So let's go. Let's talk about so we're all wrestling here with this seller's remorse and this. Are we wrong? So I included this Dilbert, because he's laying out a scenario for the boss in blue there. And the boss wants him to admit that he's wrong if something doesn't go the right way. And you can see the tug of war that many of us have been involved in boardrooms, etc. And I guess my point is that there is no real way to judge anything like this. We feel wrong about what we did for the round table with Apple, and I think we were wrong not to use the trailing stop program trade. I think that was an oversight on our part, and we need to be mindful of that. But criticizing any one decision, who knows? Who knows? And the only thing that we can keep track of is that overall performance, which again showed basically about a 17% return for the roundtable portfolio. That if we actually put our arms together and crossed them in front of us like Barbara Eden on Dream of Jeannie and blinked our eyes and said, well, what if we never sold anything? The return on that portfolio drops down to a 10 or 11%. And that's what we're really talking about. I think, again, over 10 years, you can begin to make conclusions about whether you're generally right or generally wrong. And that's kind of what I'm getting at here. And I do want to point this out because what you're looking at on the screen is a 25-year price chart for Cisco Systems. Many of you in the community will remember this one well. I bring this one for very specific intent here. First of all, on the left-hand side of the chart, you've heard the stories. We found it in the Emerging Companies Handbook from Hoover's that you can get and take a look at. That's when our investment club and we personally bought into it, and we had one heck of a ride. And we wrote it all the way up here, and I think that should have been subject to the same type of discussions that we're having here today. Fortunately, I was actually forced because I was moving some accounts around to sell it somewhere in this range. So we were somewhere near the top, but there were a number of discussions in the community at the time. If you looked at a stock selection guide at the peak of this chart, at the point where this was maxing out actually at a level of 90 on the relative strength, which is definitely a danger Will Robinson moment. You want to take and really think about the company, perhaps subject it to some of the stuff that Ken was talking about a few minutes ago with core stocks and that sort of thing. But I vividly remember the projected return on Cisco with an aggressive stock study being like minus 15% or minus 20%. And they were an extremely aggressive company. And I just want to make the point that, because I don't get things right like this very often, but Cisco has not, 20 years later, has never reached that price. It's never been back to that price. It came close a few months ago, but it's never been back there. So that's a case of sometimes you got to be willing to buck the trend. I don't think Apple's going out of business tomorrow, but I would never have expected this from Cisco, and I meant the word never. I try not to use that word, but not in this case. Cisco is an extremely strong company. And one of the other points I want to make is I wrote a column for Better Investing. I wish it was still available in the archives. It's been apparently blown away. But in it, I talked about jumbotrons and all that kind of stuff. At this point in time in history, with the stock price at 62.5, it was by far the most assertively recommended stock on Wall Street. at the time when a stock selection guide that I'm sitting here holding it in my hands was minus 20%. And I look at that chart, says that, you know, there's a case where something worked out fairly well over time. So that's getting one right. You never know. And then there's this one. One of the most colossal bonehead threads I've ever done was believing General Electric was going to be okay about 18 months ago. And I actually chided some people for decisions they had made. And I want to apologize. If you were one of them out there, that was a mistake on my part. And then you see the little Walgreens on the right there, Ken? You know where I'm going with this, don't you?
Yep.
We were actually at a large investment club meeting in Michigan years ago. And if the ladies on the call, I apologize deeply because I wasn't mean. I think I was fairly diplomatic, Ken. Can you at least give me that?
Yes, I will.
Okay. Well, she had done a stock selection guide for the club where she used PEs and a PE of 8 or 9 for Walgreens. And I got out the charts and I said, look, it's always 16. It's always 18, you know. Ma'am, I think you're wrong. You're just being overly conservative. You know, that growth rate will never drop down to 6%. And I basically criticized for being overly conservative across the board. And you know what? I'm not going to look at it with you guys here today because frankly, it's too painful. Walgreens is growing at 5% with a PE, a trailing PE of 7 right now. So I guess my nutshell is this is an incredibly humbling business. So be careful about being too strong on any opinions. Be tolerant of everybody's opinions and try not to use the word never.
Mark, could you go back 2 slides?
Sure.
To the Cisco slide?
Sure.
I did a presentation in 2004, 5, 6 in that general time area about vocabulary. And 2 of my favorite words at that part of my maturation as an investor and the work that I was doing at that point were that if you held Cisco in 99 and did not hold it by 01, then you were disciplined. If you held Cisco in 99 and still held it in 03, then you were stubborn. And the difference between disciplined and stubborn was a lesson that I thought all beginning investors had to learn. And I think a lot of them have to learn it. I know I did. You have to learn it with real life experience. You can't be told the difference between the 2 words, but there's definitely a difference between those 2 words, being disciplined and being stubborn.
Yeah, absolutely. You talk about lessons that can be learned from a situation like that. Again, going back and understanding how Cisco was conducting their business, using their stock as a currency for aggressive takeovers, all that stuff is things that can be learned. I'd like to close here today with just a thought about, and this goes to Ann Manning's question. I know she's still shaking her head or scratching her head down there in Houston. A belief that I have, and this is something Ken and I have kicked around a little bit. Is it possible that our average return forecast is currently artificially inflated? And based on what I've had to say in here in the last couple of slides, yeah, I think it's possible. I don't know the answer, but I think it's possible. And what I'd like to show you is just a couple things. This is from a JP Morgan report that came out last week that identifies a bunch of stuff that's going on around the world to inject stimulus. In many cases, that's the direct acquisition of securities. And it's a big pile of money, a humongous pile of money. And what I find fascinating, I didn't know this, perhaps most of you did, but I didn't know that they basically haven't spent any of it yet. And now they're fighting over the next round already. I think I have a problem with that. I promise not to get political here, but how in the world could we be thinking about issuing another set of funds to do this kind of stuff when you haven't even begun to figure out if it's working yet, necessary or whatever? And this notion of dry powder, I had no idea this looked like this. And I think it's absolutely ridiculous that they could be standing on Capitol Hill making that argument right now. So anyhow, one of the things that we have noticed, we haven't talked much about it, is back a few years ago, we pointed out how the projected annual returns tended to mirror, and again, not on a company by company basis, but in general, the projected annual returns actually lined up very closely with the value line low total return forecasts. There's actually an article, you can reach the link at the bottom of the page and go back and take a closer look. Again, this low total return forecast for any company is in the projections box. We talk about it at virtually every roundtable. It's right there. And notice that over the last few years, there's been a creeping difference. Does this kind of capture what you were thinking about, Ken, the other day when we talked about it?
Yes, very much so, Mark.
So the PARs, our projected annual returns, have been creeping away from the value line low total return forecast, which again has a fairly good track record as far as resembling what actually happens. So I think this is an important thing to recognize. And it comes from a couple of different sources. One of them is a little bit of exuberance when it comes to PEs from the analysts. But there's an even more stark one that we can take a look at. Here's the three side by side as of today. And this goes to the question you asked a few minutes ago, Ann, about companies in general and how those numbers are going to be different and how we should be looking at them. I fully expect, because for one thing, it looked like this just a few months ago, and these were pretty much the same. And this has been shrinking. It's been shrinking. So the projected returns have been shrinking. And I believe that these numbers, when they're, after some head scratching and reconciling and over time, I think they will resemble each other more closely than they have for a while. Again, more closely than what we've seen here. Here's the reason I believe that. First of all, some of the PEs from the analyst consensus are a little bit frothier than they've been in a while. But I think this is the bigger reason. And this is that chart that we've been describing as the recession watch at Manifest. And again, if you go back about a year, we were on that red arrow trajectory. Okay? Hopefully everybody's with me on this. In other words, all of these that are now down here, all of these that are in this range down here, were actually up pretty tight to this red line. And the sky's the limit. Anytime we get one of those trends in place, it really whips the analysts, the rhinos, into a frenzy. And they start extrapolating from that. And I've never met a pessimistic rhino Wall Street analyst. Well, I guess I have, but they get drowned out by everybody else. So what you see happening here is that compression, where we're actually coming back to, there's nothing wrong with that blue trend. But we're actually kind of twisting and contorting back to it. And that's why you see that happening, this compression that I'm talking about here. So this is what I was talking about, Ken, when I say I think I'm actually sitting there seeing this on a company by company basis. And the air's coming out of those forecasts. So now come back to your question, your observation about portfolio-centered actions responding to that average projected return. And that again gives you more pause, gives us more pause, P-A-U-S-E, more pause when it comes to trying to stay 5 points ahead, because we're having a hard time keeping some of the portfolios that we follow 5 points ahead. By the same token, it means don't be quite so quick to pick on the ones on the low end of the screen. We still want to be diligent about doing it and putting everything through its head scratching paces, but it suggests to me that a disciplined caution is also in order. Does that make any sense at all, Ken?
It makes a lot of sense, Mark, and I know that we don't have time to enter it into the discussion, but I think it would help in the next couple of weeks also for us to examine how different the last 4 months have been from almost anything that we've seen. I mean, with 0% money freely available, with liquidity being pumped in everywhere, with all the different things that people are trying to prop up what's going on in the economy. I think that that tends to soften or break some of the long-held rules that we've talked about. And maybe part of that is this whole concept that every single thing that goes on in the stock market has a fundamental reason behind it. I know that you're not a big fan of PE values, but I keep looking at stocks with PEs of 70 and 80 and 90 and 100, and I keep asking myself, how long can those PEs exist? I understand they might exist for a day or a week or a month or 3 months, but can they exist for 3 years or 5 years, for any particular company that we're looking at? And it bothers me that there is so much cavalier attitude towards high PE ratios. I think that they're important. I don't think they're important day to day, but I certainly think they're important when we look at them in the long term. And I'm concerned right now about some of the PE ratios. I can remember when Apple sold at a PE for a long time of 10, 11, 12, and it's certainly not selling for that PE anymore. And yet I don't know, how much has changed within the company to make that happen. So,
in fact, they have only in recent years started taking on debt. And usually a company, as its growth slows, that takes on debt, it's natural for the PE to compress. And we're kind of flying in the face. And then you've got the flip side of that is we're in a 0% interest rate environment. And low interest rates historically mean that the general PEs are increased. And we'll actually show this next week, I think. PEs are projected to go down in a 0% interest rate environment. I'm with you, Ken. And for those of you hearing picking on me on PE ratios, I love PE ratios. They're part of all the analysis that we do. I like projected PE ratios better than current PE ratios for making decisions. We can go more into that. And again, you have to be careful if you're talking about an early stage company in PE ratios as to whether or not the PE ratio should even exist or be used. So yeah, there's lots of things to think about. And we look forward to exploring some of these topics. That is a topic for next week or the week thereafter, early stage investing and that kind of stuff. So guess we'll leave it here and see if anybody has any closing comments. I like the picture of the bulls relaxing a little bit, but that bear is always there.
We're getting some comments that some of the things we've said in the last 3 or 4 minutes, people would definitely like to build on those next week, Mark.
Yeah, we'll go there for sure.
Okay. And meanwhile, we're just a little bit after 3 o'clock, so much more disciplined today, Mark, okay?
We'll try to remain disciplined as best we can, but there's some interesting stuff that we can kick around, guys, and we will.
Certainly is. Yeah.
All right. So again, I invite you to give any suggestions about topics or companies to look at. In fact, as Ken was talking, the one that I thought we might kick around in greater detail is Adobe, and Adobe is clocking in at PEs between 40 and 50, and it just begs for me the question: is this the new paychecks? And I remember back when we used to talk about paycheck, how long can the PE for paychecks be 50? And the answer to that was, I don't know, maybe they can do it forever. Well, that's not the right answer. So I looked at Adobe. Adobe was a company I updated this morning. It's rich. It's rich.
Mark, I want to put in a plug for a list that I was looking at today and was pleasantly surprised to read through. That's Jim Cramer's COVID index. I would urge all of you to go to your search engine and type in Cramer and COVID, and it'll take you right to the index. He has the list of 50 or 60 companies that he's put together and then formed an index from, and they're actually tracking it. But first of all, I think you'll be surprised at how many of them are in your own portfolios. Cramer I think invests a lot like we do, even though he's a little bit louder sometimes. But there's some great ideas on that list, in addition to some brand new companies that I was not even aware of, and they give me pause to look for some of these things to put in my non-core holdings in my portfolios.
Fascinating. Are you going to force me to read another Kramer book?
Not yet, no.
Okay. I say that completely in jest. We read and did a book report. We might actually, I'll throw a link to that on the weekly update. We were pleasantly surprised by Jim Cramer's latest book. I believe it was Back to Even. Whatever it was quite a good read. And I will add the COVID list to the topic list, Ken.
Great.
All right. Anything else?
I'm gonna sign off and say goodnight to everybody, and we hope we see you at the roundtable. Those reminders for the roundtable are going out tomorrow, I think, so you should be getting them in your email box.
All right. Thanks, everybody. Be safe.
Bye-bye.